Hi everyone, let's talk about foreign exchange markets. But firstly, let's talk about currency. The currency is basically something that is used to express price. Everything in the world has a price. From this shirt to this handphone, everything has a price. For example, this handphone is worth 2 million rupiah. So I can only say that because I have a rupiah to express the value of the handphone. This is 100,000 rupiah. But what is 100,000 rupiah worth? Well, to say that, we need to talk about foreign currency. So we can say that 100,000 rupiah is actually worth 1/50th of this. 1/5. So, but who says so? Why is this equal to 5 of this? Well, the foreign exchange market says so. The rates of exchange are determined by the foreign exchange market. And the foreign exchange market, therefore, in turn determines the value of the currency. And they are actually the most important part of financial markets because foreign exchange rates determine the flow of investment, the interest rate in the country, and the inflation in the country, and a lot of other considerations on trading patterns around the world. And this has been going on for a long time, even before your grandparents were born. It was happening since the medieval era until now, all over the world. From when people were using silver coins, paper money, to the e-money we have right now, foreign exchange has been happening. But where, you ask? Where is this happening? Well, it's happening in 4 different kinds of markets. The first one is the spot market. This is where most ordinary exchanges take place. For example, when you take out your money to the foreign exchange money exchanger and then you buy some dollars, that is the spot market. A transaction that's done immediately. The second is the futures market. In the futures market, you sign a contract which allows you to sell or buy currency at a set price when you made the contract. This is useful to protect yourself against risks of the currency going up or going down unexpectedly. Third, there is the options market, which is actually a more advanced version of the futures market. And the options market lets you sell and buy securities at several prices at several points in time. That's why you have a lot of options, and that's why it's called the options market. And lastly, you have the derivatives market, where most foreign exchange trading takes place now. The derivatives market is basically this huge, complicated web with a lot of very advanced financial instruments, and the derivatives are bought and sold in the secondary market, and they constitute the most part of financial foreign exchange markets today.
Okay then, let's get to the next topic. So what are the players that are included in the game of currency trading? First is exporter and importer. Second one is investor, and the third one is government or central bank with their reserve. The last one is speculators. Why exporter and importer are included in the game? Because they have to change their currency in order to buy goods or sell goods or services. The second one is investor. Why they are included? Because they have to change their currency to the target of to the nation target. For example, from Singapore, they want to invest their money to Indonesia, so they have to change the the dollar of Singapore change to rupiah. The third one is central bank. Why? Because they have to manage their reserve in order to maintain the exchange rate. The last one is speculators. Why? They have to analyze the movement of the exchange rate in order to gain profit of the volatility of the exchange rate. So, the next question is where do they trade their currency? Everywhere in this world, including this. I can change my currency with this. But the main place that currency traded is interbank. The trading between bank and bank. And the last one is settlement. What is settlement to us? It is the agreement from two parties in order to exchange their currencies. So in this settlement, they have a risk. We call it interest rate risk. For the last but not least, how we know the movement of the exchange rates. It depends, short term or long term. The short term is based on the latest issue, like news or something else. So about the long term movement of exchange rates, we know from the real interest rate equals nominal exchange rate subtracted by inflation rate. That is why investor will know about the long-term movement of exchange rates.
How do we manage exchange rate? There are three systems of exchange rate. The first is fixed exchange rate. The second is semi-fixed exchange rate. And the third is floating exchange rate. Let us talk about fixed exchange rate first. There are various types of fixed exchange rate. The first is, and the oldest one is, gold standard. Under gold standard, any currency of a country will be directly linked to the gold. So any coins at the time will be transferred to the gold at any time. The second is Bretton Woods. Bretton Woods system tried to fix the problem in gold standard by allowing countries with deficit to devalue of its value at any time. And the third one of the example of the fixed exchange rate system is PEX. In PEX, a country decided to set the value of its currency constant in terms of another currency. And how about semi-fixed exchange rate system? Most of the system involve managed flow, in which government allows currency to float and move freely with market forces. But the government actively seeks for market guides. The type of semi-fixed exchange rate, such as bands, target zones, and rolling peg. And how about floating exchange rate system? Under this system, the exchange rate is not the main focus of the government. The government and the central bank are focusing on another goal, such as stabilizing the price of the central and stimulating the economic growth. And to do so, they allow the currency to float as the market wanted to.
How can markets and policymakers judge whether a currency is undervalued or overvalued? There are three different indications that a currency may be seriously misvalued. First, its exchange rate with other currencies may not be moving towards cover interest parity. Second, a country may run. The third indications of the misevaluation is when the before-tax prices of traded goods in a country is very different with the prices of another country. In managing floating rates, governments and central banks wishes to alter exchange rates without making fundamental changes to the economic policy. Authorities often resort to an intervention to support a currency that has been falling down or drive down a currency that has been rising. Evaluating changes in exchange rates between two currencies is simple enough. Evaluating how a particular currency has performed over time is, however, much trickier because we must consider the performance of a currency with many other currencies. Intervention, which always done in secret, usually involves a country foreign currency reserves to buy domestic currency in the markets, thereby strengthening domestic currency's price. The most widely used method for doing this is by constructing trade-weighted exchange rate, which is an index incorporating currency's performance against basket containing currencies of all of its trading partners. The weighting is done based on the share of the country's trade that can be attributed to each trading partner.